as usual with the Federal Reserve, what it says and what it does are two entirely different things. So this entire week, the narrative in the mainstream financial media and with Wall Street investment banks is that rate hikes are coming immediately to fight inflation and that the Fed is going to drastically reduce its bond buying program. It's going to cut it in half again. It's going to be halved. Meanwhile, here in reality, in just the last week, the Fed's official balance sheet is up another $92 billion. And since January of 2021, the Fed's official balance sheet is up over $1.4 trillion. So we have the false narrative from the Fed, we have the false narrative from Wall Street, we have the false narrative from the mainstream financial media versus the reality, versus how the Fed's official balance sheet is still trending upwards despite the supposed tapering and an increase in tapering. So if the Fed does increase interest rates in 2022, and now apparently at least 3 interest rate hikes are already priced in or are going to be priced in soon, according to Wall Street investment banks, and also that chart I have there on the right-hand side of your screen, it's saying at least 3 interest rate hikes in 2022 are already priced in. That will break a lot of things in asset markets and the real economy, especially asset markets. So what will break if the Fed does hike interest rates a quarter point and then another quarter point and then another quarter point? Morgan Stanley's even claiming that the Fed's going to hike interest rates 5 times in 2022 and 2023. So 5 total interest rate hikes. That would break so many things. What will break? First off, the U.S. real estate market and home prices. A lot of it is based off of interest rates and refinancing. Respected real estate investors and professional real estate investors like Jason Hartman and George Gammon have talked about strategies like refi till you die and others. Well, if the Fed is hiking rates, that refi till you die strategy, where a lot of people keep pulling home equity out, keep refinancing their mortgages, that stops. Wall Street banks can't sell as many mortgage-backed securities during a rate hike cycle. Mortgage-backed securities also tend to not do as well. A lot of people tend to default. So housing prices could come under pressure, which means then government finances, whether it's the U.S. federal government with capital gains taxes on real estate or the state and local governments, the counties and the cities and the states with property taxes, if real estate prices crash because of interest rate hikes, that would also hurt. Wall Street investment banks, if interest rates go up, that means U.S. treasuries become more attractive relative to the Wall Street bond salespeople trying to sell more and more junk bonds, more and more leveraged loans, more and more collateralized loan obligations and other risky corporate debt to suckers. Because U.S. treasuries with higher interest rates on a relative yield basis, they're viewed as safer to most people. I would argue they're not safe either, but most people don't see it that way, especially if you're a regular bond fund manager relative to junk bonds. So then the Wall Street bond salespeople, which means not as much commissions, bonuses, promotions, extra profits for the bank, all these things that Wall Street gets from selling toxic sausage derivatives and corporate debt for leveraged buyouts and share buybacks with debt and junk bonds. If the interest rates do go up significantly, that would stop. And then asset markets would also break because you have all of these hedge funds, family offices, and portfolio managers at investment banks, whether they're a bond portfolio manager, an investment bank, or long short equity hedge fund, or a lot of these global macro guys that every time the gold price drops, they say that the gold price is going to crash more. A lot of them have enormous amounts of leverage bond trades on. And guess where they're also borrowing from? Not only have they borrowed from a lot of different places, they've also borrowed from the offshore euro-dollar markets too. There's a lot of hedge funds, family offices, and portfolio managers at investment banks that have overborrowed and overleveraged their trades and borrowed from a lot of shockingly risky and opaque places. So if the Fed does hike rates, it will blow up a lot of these leverage trades too. Unless, of course, the Fed is planning for a short-term market crash. But if asset prices do crash, then the problem for the U.S. Treasury is that the capital gains taxes that they're projecting for stocks, bonds, and real estate, those aren't going to come in. And then the budget hole for the US Treasury blows up even more. And then the Fed has to monetize, buy even more US Treasury bonds to subsidize the US federal government budget deficits, because Congress doesn't want to cut back on spending. Congress wants to increase spending. So rate hikes, I think this is a false narrative. We'll see what happens. If the Fed does hike rates a couple of times, though, it's definitely going to blow something up, something important up. Could blow a lot of things up, actually, especially if the dollar index rises. If the dollar index keeps rising, we could have enormous blowups similar to the Repo Madness 2019 crisis. And then also what happened with the other dollar index rally in early 2020, how a lot of foreign banks and foreign corporations had enormous margin calls. There were probably also hedge funds in there, family offices, and portfolio managers at investment banks that also borrowed in dollars from the euro dollar market, and they were getting margin calls too. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content research, financial education, and analysis than I'm providing these short little free videos, there are now over 190 articles and audio podcasts behind the paywall, including 36 new articles and audio podcasts in the last 23 or so weeks, and 6 new audio podcasts in just the last 3 weeks. They're all 15 to 25 minutes in length, except for a gold stock update, which was about the tax law selling and the institutional investors dumping gold stocks for the last 3 weeks. That's why gold stocks were down between 3 to 5% per day. There was enormous institutional investor dumping, relentless dumping of gold stocks, and then the tax law selling compounded on it. Although after the Fed announcement, gold stocks have rallied a little bit today, but the fundamentals for gold in the long term are actually improving. Demand for physical gold outside of the United States, outside of the West, I'll cover this on another short video. Private sector demand is increasing. So there are a lot of audio podcasts on the uranium market, gold and silver miners, their earnings problems with Q3. Q4 is going to be bad as well. Precious metal royalty and streaming companies, which are going to take advantage of the gold miners, which are not going to be able to raise equity, and rising geopolitical risk in the mining sector as governments are desperate, not just the US government, are desperate with stagflate tax lie and are looking for new sources of tax revenues, and they're looking at taxing a lot of these miners. It's not just in 1 or 2 countries, it's across the board. And all of this content is exclusive for patrons behind the paywall, all for the cost of a Starbucks cup of coffee per month, only $5 a month. I think it is one of the best deals out there. There is a lot of in-depth research on global macro companies and sectors behind the paywall for a very reasonable price. So if I could wrap up this short little video very quickly, you have all these Wall Street investment banks, you have the Federal Reserve, you have the mainstream financial media claiming that it is locked in, that the Federal Reserve is drastically going to taper their quantitative easing bond purchases, mortgage-backed security purchases, etc., is going to raise interest rates at least 3 times in 2022 and potentially more than that in 2023. And I'm laying out the case here that the more the Fed hikes rates, even a quarter points, so even a couple quarter point rate hikes, the entire global financial system, especially these leverage trades that these hedge funds, these family offices, these portfolio managers at these investment banks, these leverage trades that they put on derivatives, bonds, currencies, stocks, commodities, all these things, drastic amounts of over leverage. Even retail investors have copied them. There's an insane amount of retail traders that have over leveraged buying stock options, over leveraged buying crypto and altcoins, over leveraged buying NFTs. The leverage in the entire system is nuts. All betting on perpetual asset price inflation, a lack of the VIX rising and volatility, and it is extremely fragile. So the system is the exact opposite of what Taleb has talked about with being anti-fragile. It is very fragile, as in a couple interest rate hikes could break the system. The system is a debt Ponzi scheme with way too much corporate debt, way too much government debt, and yet the amount of total debt in the entire system miraculously keeps growing, even though governments and corporations can't mathematically pay off the debt, and they're having trouble even servicing it at this point. So there's a lot of warning flags, whether you see the VIX spike that occurred in the last couple weeks before the manipulation and the smackdown, the Eurodollar futures curve rising, which to me signals that there was a top-down problem, not only with the dollar index rallying and a margin call with foreign governments and foreign corporations who borrowed too much in dollars, but also these hedge funds, these family offices, and these portfolio managers at investment banks drastically over-leveraging all their trades. I am very, very confident that a lot of these global macro experts, and I'm using air quotes here, borrowed from wherever they could. If it was the Eurodollar markets or elsewhere, to leverage up the trades. They borrowed from repo, they borrowed from Eurodollar. Some of them may have even borrowed from loan sharks. That's how ridiculous the leverage in the entire system is. That's how over-leveraged some of these trades are with a lot of these asset prices. And the Fed raising interest rates. The system is so leveraged, especially asset prices, that they could break real estate markets, that they could hurt Wall Street banks' profits and Wall Street bond salespeople's commissions, sales commissions and earnings. All these toxic sausage derivatives, these credit products that Wall Street banks love to chop up and sell onto suckers. If the interest rates go up, junk bonds could blow up. The amount of junk bond sales could drastically decrease because then U.S. Treasuries look even more attractive at a higher interest rate to most, especially foreign investors. And it's interesting that gold and gold stocks are rallying the last couple days on this priced in after so much selling in gold stocks the last 3 or 4 weeks. But the bottom line here is that the Fed is trapped in a number of different ways, whether it's U.S. federal government financing. If asset prices do crash, the Fed would actually have to monetize even more debt. And the Fed cannot hike interest rates to fight inflation like Paul Volcker did in the past. So the Fed can basically only jawbone and maybe attempt 1 or 2. I think at 3 rate hikes, I think things will blow up. Things may even blow up. Asset markets and leverage trades may even blow up before 3 rate hikes. I'm not even sure if the Fed can even try 1 or 2 at this point. That's how bad things are. But the Fed still wants stagflate tax lie. The Fed still prefers asset price inflation. The Fed has walked away publicly from their stance during the Alan Greenspan Fed, during the Ben Bernanke Fed, and during the Janet Yellen Fed about the wealth effect and the benefits of asset price inflation, because now the wealth disparity or the wealth gap from the people who own a lot of assets and have benefited from the asset price inflation the last couple decades and the people who do not, the people on Main Street who are getting killed from the bottom up with stagflation and taxes on so many different things, consumer goods, all these things, stagflation and taxes. Those are the ones who are going to start to get angry at the Fed if they do their research and understand how the global financial system with this dollar as a world reserve currency, the dollar standard, is currently set up. So there are top-down macro problems with leverage, and there's a lot of red flags there. And then there are bottom-up problems with inflation and taxes for the average regular person and business owners with higher costs, higher labor costs, higher fuel costs. All these costs are up across the board. Food costs are up. All these costs are energy costs in many cases, especially in Europe, the United Kingdom, and China. Energy costs and electricity costs, if there's even energy and electricity available, costs are up insanely high across the board. So you have all these different problems. And unfortunately, a lot of mainstream financial experts are not correctly identifying a lot of the problems. They're just talking about how the Fed's going to fight inflation now. But the Fed can't really fight inflation. The Fed is trapped because of policy mistakes that it has done for the last 2+ decades.